Pay-as-you-earn is a method of collecting tax from individuals who are in gainful employment, and it is the sole responsibility of the employer to actually do the deduction. And when we talk about gainful employment, we are talking about someone who is earning salaries, wages, commissions, maybe gratuity, and other maybe benefits from employment that the person may be getting. The employer deducts the employees who earn 24,000 or more. So for the employees who are earning less than 24,000, you will realize they will not be paying any tax, because when you compute the tax, it is equivalent to the personal relief. It is the responsibility of the employer to deduct the pay-as-you-earn, to account for it by filing the pay-as-you-earn returns on or before the 9th of the following month, and to limit that tax as well. To file for pay-as-you-earn, you need the first thing to add the tax of the obligation, and then you go to iTax. Under file returns, you will see the aspect of the pay-as-you-earn. Then you will download the pay-as-you-earn return, fill in all the details. After filling in all the details, then you will submit. By filling in all the details, I mean the pay-as-you-earn returns has various sheets. So you need to fill the sheet for the full-time employees, for the secondary employees, and the ones for benefits as well, if there are any gratuities, and then any other benefits that was not among maybe the basic salary and the like. And then the system will automatically compute the tax payable. So once you submit, then the system will give you the tax that's supposed to be paid. And it's at that point now then the next step is to make the payment, where the employer prints an e-slip and now proceeds to make the payment. The due date for pay-as-you-earn is on or before the 9th of the following month. By that I mean, like the pay-as-you-earn deductions for the month of April, the employer ought to file and pay the taxes on them on or before the 9th of May. The employment income that's chargeable to pay-as-you-earn, you basically notice it's all the gains and benefits that an employee would be getting from employment. So what the Act or the Income Tax Act does, it goes further to tell us what are those incomes that are not taxable. So in other words, we are saying all the gains and benefits that you get from the employment will be taxable except for. So maybe then we can look at what is that you get from employment that's not taxable. Number one is staff meals. When the employees get staff meals, and not in monetary terms, but as food from the employer, either the employer provides the food or the employer has gotten a provider of the food, and the value of that food does not exceed Kenya shillings 4,000 in a month or Kenya shillings 48,000 in a year, then that is a tax-free benefit to the employees. The second kind of benefit that's tax-free to the employees is fringe benefit. By fringe benefit, we mean when the employer gives employees loans, then the person who pays tax on fringe benefit is the employer, not the employees. Number three would be benefit in kind. If the employer is giving employees benefits that are not specifically stated in the Income Tax Act, then in such case we look at the value of that benefit, and then we say if the benefit is less than 3,000 in a month, it will be tax-free. But if it's 3,000 or more in a month, everything becomes taxable on the employee. Now, the other kind of benefit that will not be taxed on the employee would be the pension contribution by the employer. So you notice, unless the employer is exempt from tax, for the employers who pay tax, the pension contribution made by the employer towards the employee will not be taxed on the employee. You also realize a benefit like medical benefit will also not be taxed on the employee. It is whether it is an insurance cover that the employer has taken, or it's a cover, the employer has organized means of providing the cover to the employees, that will also not be taxable to the employee. You also notice for persons living with disability who have a valid exemption certificate, they do not pay tax for the first Kenya shillings 150,000 per month of their employment income, all of their income. So such a person also will not pay tax if they have that valid exemption certificate. So those are some of those benefits that do not attract pay-as-you-earn. But now you realize, now the others will be attracting. Just to note something, with effect from the Tax Amendment Act of 2020 that came to effect 25th April 2020, initially the bonuses, the overtime and pension for the employees who were in the lowest tax band were exempt. Now that has been done away with. So even those employees who will be in the first tax band, when they get the bonuses, when they get the overtime, and when they get the pension, it will be taxable on them. The current monthly personal relief is 2,400 per month. This has actually been an increase. Initially, it used to be 1,408. Yes, the government has actually now considered the employees.
What is the penalty for late filing?
Late filing for the pay-as-you-earn returns, which we say that they are due on or before the 9th of the following month, is 25% of the tax due, or Kenya shillings 10,000, whichever is higher.
That one again will be kidogo. So you can start with the penalty of 10,000
yes,
or 25% of the tax due, whichever is higher.
Okay.
Okay, so what is the penalty for late filing?
Okay. The penalty for late filing for pay-as-you-earn is 25% of the tax due, or Kenya shillings 10,000, whichever is higher. The main compliance concern that have been noted in relation to pay-as-you-earn is where the employers treat part-time employees as consultants instead of part-time employees. So you'll notice that the employer will end up deducting a withholding income tax of 5% for the resident consultants instead of deducting pay-as-you-earn up to the rate of 25%. So for the part-time employees, let us treat them as part-time employees, not consultants. Now, the second concern we have noted is whereby the employers give benefits to the employees and leave them out. Some employers feel where the employees are just earning wages, that is not taxable. So you realize that even wages, commissions will be attracting pay-as-you-earn. So we need to include all those gains and benefits from employment. The penalty for late payment of pay-as-you-earn taxes is 5% of the tax due, and also any tax that remains unpaid after the due date attracts an interest of 1% per month.